The Morgan Report with David Morgan.
And David Morgan with you from the morganreport.com for the weekly perspective for the week ending 7 October 2022. Well, before I start, I want to get one of the most fundamental facts out. It's been said thousands of times, thousands of ways. But as simple as I can put it, there's two types of money. There's debt-based money and there's debt-free money. Debt-based money is how the entire system is constructed. Debt-free money is gold and silver. There is a small quantity of debt-free money and a non-stop, ever-expanding amount of debt-based money. They're coming to a juncture in a neighborhood near you very soon. Those that will be left standing, for the most part, will be those that have debt-free money. Those that will be hurt the most are people that base their savings, retirement, pensions, mortgages, student loans, car loans, credit card loans on a debt-based system. So having said that, I want to talk about what I usually do on a weekly perspective, and that is gold and silver, of course, the economy as well. And we had quite a week. So on Friday, September 30th, a week ago, we had a silver spot price of $19.03. On the open Monday, it shot up and closed, according to Mike Maloney's goldsilver.com, $20.77. And it actually had followed through a little bit and moved up to 21, as you can see on October 4th, and then it's tapered off, but it's maintained above 20. So that $1 plus gain, that $1 gain, I'll call it, has maintained for the week. 9% move, and that shows you what silver can do on the upside. Of course, all markets go up and down in terms of paper, pricing, but an ounce of silver is an ounce of silver and will remain an ounce of silver, meaning a debt-free monetary asset that you actually determine the value of in some ways. In other words, if you were to barter that ounce of silver, you could negotiate what you get for it. Looking at some of the headlines from Yahoo Finance as one, gold tumbles after U.S. jobs data keeps Fed on hawkish track. As from Bloomberg, gold just climbed below 1,700 an ounce after the U.S. jobs data showed the labor market remains tight, keeping the Federal Reserve on a hawkish policy track. Well, true. I mean, this is a headline. I'm not going to argue with what I just read, but let's keep in mind that part of the labor statistics, can't say it, is that about 300,000 boomers are retiring per month. So that subtracts from the labor rate. And we don't talk about that, but I will. So anyway, these headlines really are used in a way to manipulate your thinking. I want to go back and digress way back to when I was in the film, the Four Horsemen film. And one of the trailers for that movie was Julian Tennant, I think is how you say her name, worked at the Financial Times. I believe she's moved on from there. Very smart woman, very financially minded and very accurate. And she talked about, money and finance, but she talked about the cognitive map. I think those are her exact words. In other words, if you could control the thinking of people about money, then you could control them. And those are my words. That's my take on what she said. But it's true. If you could get people to think that debt is money and control most people to think debt is money, then you have a lot of control because you can inflate the debt to a level to where it doesn't work anymore, which we're fastly approaching. And then all that's left is the assets that have been built on that debt-based system, and everything that's superfluous basically goes away and everything gets repriced. And usually one of the main places it gets repriced is in terms of real money. So there's a small amount of real money versus a almost infinite amount of debt-based money. This is an interesting chart. This shows you the rate of change. It's called acceleration in engineering terms. But what you can see here is the years. So what's showing is that the acceleration of the rate of change is the highest it's ever been on rate increases, interest rate increases. This shows 2022 with these 0.75 basis point raises and how quickly that's going versus what happened in 88, 89, 90, 94, 95, 99, 2000, or 2015 to 2018. So now, I'm not going to make a huge thing out of this. It's a fact is a fact. But you can see that the raise in 94, 95, and 99, 2000 didn't go that high. 95 a little higher than where we are now. 99 actually less. But they're pretty close to the same trajectory. Yes, this time it is a bigger acceleration. What's the more interesting question to me is where did it end? 3.5, 4.0, 5.0, time will tell. I think they are going to continue to increase interest rates until they put the new system in place, but time's running out. This is from thestreet.com. Credit Suisse is in deep trouble. Anyone paying attention to the markets knows that. Will Credit Suisse pull through? Speculation surrounding the future of the Swiss banking giant has been going on for several months in the marketplace, in business and political circles, as well as social media. The number 2 Swiss bank, one of the largest in the world, is in deep trouble and is currently fighting for its survival. So we'll see. Is it a Lehman moment? Approaching one anyway. Remember when Lehman failed, it wasn't in a lot of a different position than other banks that were saved. And the Fed, of course, came to the rescue. Will it happen again? I think it'll be tried again. Whether it will work this time or not remains to be determined. But we are getting near the end game. A lot of these, let's say, shenanigans that have worked in a debt-based system can only work for so long, and then they cease to work. And again, I think we are approaching that. Next up is an article from Kitco. Anna, a good job. Basically, it asks a question we all want to know: is the silver and gold price rally going to last? And here's what analysts are saying. She quotes some people, obviously, and there's a many that talk about the big leap that we saw. I just talked about at the beginning. Market speculation around the Fed adopted aggressive approach on rate hikes has sweetened the appetite for zero-yielding gold. And then she goes on to say here later that it remains to be determined because the short-term direction depends on the U.S. policy this Friday. A higher than expected number would trigger a more hawkish repricing and rate expectations I just went over. And so she says that she thinks that we will continue to see drops coming in the job openings, and that will put some pressure on gold. But before that, she states somewhere in here that the ability of the Fed to continue to raise rates will dampen gold. Here it is. So we see gold steam losing toward our target of 1580 over the coming months as the Fed continues to stick to its hawkish plan to move the Fed funds rate to the 4.5 mark, which I just showed you previously. So we'll argue with that being a short-term prognostication. What I will argue with is it means nothing longer term, because go to 4.5%. If the real inflation rate by their metrics is 8.5%, you still haven't got it above the inflation rate. They can't put it that high without breaking the system, and they know that. So there will be a pivot. And when the pivot happens, then there will probably be a run to gold and silver. Before that, there could be a run to gold and silver. So the Fed is in a tight spot that they basically can't get out of, but they will try. And again, they'll go back to the cognitive map. They will do their best to convince everyone that's in the markets, and the banks will play along with it because they know better to keep the game going like it can last a much longer time, but it cannot. And quickly, a reminder that the October issue just was issued a few days back. We have a new speculative mining situation with some very high drill results, and they added to those very recently. On top of that, I have 4 options plays using leaps, long-term exploration options in most of the silver space. And lastly, I'll give you a real quick look at the start of the report here, as you can see. And we talk a lot about what's going on right now and looking at the debt markets from the exterior pyramid. And this is something I've talked about over and over, but it does bear knowledge. If you have an understanding of what's happening now, I don't think it could be summarized better than the exterior pyramid. So stop there. This is David Morgan of themorganreport.com signing off, and I'll be back with you next week with another weekly perspective.